The AI revolution is here. But will it deliver on its promises? By the end of this year, the tech industry will have poured $717 billion into large language model (LLM) AI and the infrastructure to power it, a staggering sum compared to the $91.9 billion invested in AI by corporate customers in 2022. While estimates for next year vary, industry leaders are confident that the same scale of investment will follow, suggesting the sector is receiving more capital than has been allocated to the entire tech industry since 1956, when the U.S. Justice Department's landmark consent decree with ATT gave birth to Silicon Valley. This shift marks a turning point in the AI race, with big tech, investors, and policymakers all vowing that AI will redefine economies and societies for the better. Yet, as the industry accelerates, so does the tension between ambition and reality. Much of the debate centers on whether large language models, LLMs, are merely a confidence game, as books like Empire of AI and articles like AI Snake Oil argue. But the real question lies in who will benefit and who will falter. Even if LLMs achieve their promise, many of today's leading players may struggle to sustain their dominance. The consequences could be dire, especially for equity investors, whose stakes in AI-driven ventures could vanish if these companies fail. The race for global monopolies is intensifying. In the US, 5 or 6 major AI development programs, Google, Amazon, Meta, Microsoft, OpenAI, and NVIDIA, each seeks to dominate the market, with costs projected to reach hundreds of billions of dollars. This isn't just about control, it's about survival. As Gartner estimates, total AI investment in 2025 could hit $1.48 trillion, a 50% increase from 2024. But the question remains, will the boom in AI adoption outpace the risks? The financial landscape is equally precarious. While public-facing sales of LLM products reached $1 billion in 2023, most of the revenue goes toward training and operating these systems. Revenue forecasts anticipate sustained growth with $1 trillion in AI revenues by 2031 and $3 trillion by 2033. However, this growth is built on a fragile foundation. The gap between capital invested in infrastructure and the revenue generated by AI software is unsustainable. Investors cheer this imbalance, believing that rising end-user demand will close the divide. But critics warn that this optimism overlooks the risks of over-reliance on a single technology. The stakes are higher than ever. Media reports reveal AI's disruptive impact across sectors. Legal teams face hallucinations, educators struggle with biased algorithms, and healthcare systems grapple with ethical dilemmas. While industry leaders claim they'll fix these issues, the challenge is immense. The pressure to deliver results is mounting, with shareholders demanding proof of ROI. For many, the answer may be no, and the reckoning could be harsh for everyone involved. In a world where the future of work hinges on AI, the question becomes, who will lead the charge? Microsoft and OpenAI, with their aggressive marketing, are poised to dominate, but internal conflicts may fracture their alliances. xAI's early success with the US government could be jeopardized by Elon Musk's rift with President Trump. Meanwhile, Google, Amazon, and Microsoft rely on cloud services to shield themselves, but their infrastructure is built for multiplayer competition, not just winners. As the AI arms race intensifies, the line between innovation and disruption blurs. The industry's rush to capitalize on AI's potential may come at a cost. Will the next decade see breakthroughs? Or will the chaos of uncontrolled growth leave investors and users alike in the dark? The answer may lie not in the technology itself, but in how we navigate its implications.